The active versus passive debate has returned with renewed vigour in recent months. In fact, many column inches have been written about the subject in the media since the beginning of the year. In fact, I myself have also contributed a couple of articles. This seems to be a cyclical debate, which turns up every few years or so, either because of stock market volatility or because of some new entrant to the passive product provider space in the UK. More recently, there's been a large US passive product provider who's entered these shores, forcing the incumbent passive product providers in the UK to return fire, either by lowering fees or just raising the profile of the passive industry as a whole. Whatever the reasons, this industry is back at the forefront of investors' minds once more. So, why do investors look at passive funds in the first place? Well, the sad fact of our industry is that the average active fund has underperformed its benchmark over the past 10 years, which has lent great weight to the argument for the pro-passive lobby. Not all passive funds are the same. As you can see from this chart, there is a huge dispersion of returns of passive funds against the index over the past 10 years. And indeed, the vast majority of passive funds have underperformed the benchmark. Why is that? Well, firstly, charges can act as a drag on performance. Secondly, the passive strategies offer close but not exact replication. It can be very different to replicate an entire index. So a lot of passive strategies use sampling. And thirdly, some passive funds only offer investors access to the capital returns of that index, not the total return. If you look at the total return of a market, so over a one-year period, you can see that capital return is the key driver to total return. If you extend that out to 5 years or beyond, you can see that in actual fact, income is the key determinant of total returns for investors. Now, passive investing also assumes the market is efficient, but we all know the market is inefficient. The market often misprices companies, either because of short-term news flow or market noise, the result of which the market can become distracted by that information flow and therefore ignore the long-term fundamentals of any given company. Another issue to debate is that we know that passive funds, by their very nature, have to replicate the stock index constituents and the sector constituents in any given index. And there can be periods of time in history when stocks or sectors can become disproportionately large in the overall index. If you go back to March 2000 as an example and look at Vodafone following its acquisition of Mannesmann, Vodafone represented some 16% of the FTSE 100. Would any rational investor want 1/6 of their portfolio in any one stock? Let's take a more recent example, April 2008, where the oil and gas and financial sectors accounted for over 40% of the FTSE 100. The trouble with this strategy is that you now have perhaps a portfolio that's overly exposed to two sectors. And given any market punishing of a specific stock or sector, investors are horribly exposed to market gyrations. Now, we all remember the Lehmans debacle of September 2008, and banks got hammered in the months following that. In Q4, banks had a horrible period of time. The market dropped by about 11% in Q4, but banks were down almost 40%. That is a huge drop. So surely any investor would like to have avoided banks during that period of time. And if they had, their returns could quite well have been more positive than the overall index returns. Passive funds have to replicate the stock and sector constituents of an index. So if I again go back to March 2000 as a classic example of this, we can see that those stocks that went into the index numbered quite a few technology companies. And following their arrival in the FTSE 100, they then suffered precipitous declines in their share price over the next months and years. Conversely, those old economy stocks, so-called, that fell out of the index, saw strong relative share price rises in the months and years following their exclusion from the FTSE 100. In other words, a passive strategy would have been forced to have bought high, those stocks that went into the index, and forced to sell low, those stocks that fell out of the index. That's almost the opposite of what any sensible investment strategy would be all about. If you look at the bond indices, as you can see from this chart, financials made up a disproportionate share, in fact the majority of the overall bond index. But if you think about it, those companies with the biggest debt burden will carry the biggest component in any bond index. In other words, a bond index is almost an index of the biggest sinners. Now, there's also a popular misconception amongst investors that equity market returns are tied to economic growth rates. But as you can see from this chart, that is simply not the case. Indeed, some of the fastest growing economies of the world, such as China, have offered some of the weakest equity market returns compared to the West, which has said arguably had the lower or slower rates of economic growth, and yet those equity market returns have been the best. So why be a slave to the market? Active managers are not tied to any stock or sector components of an index. What active managers try to do is identify those stock-specific opportunities that offer the greatest long-term risk reward. And just as importantly, active managers can also react to changing market conditions, changing fundamentals, way before any index gets rebalanced to reflect those changes. So the reality is that for long-term returns, active stock selection is the key to success. Many people talk about the lost decade for investors. And indeed, if you look at the last 10 years, the FTSE has returned a relatively paltry 29%. Of course, passive funds, the average passive fund has also underperformed the index in that 10-year period. But the reality is, if you then look at the top 10 active funds over that time period, investors would have achieved a return of well over 120%. What lost decade? Let's take a look at the globe. Look at the FTSE World Index, for instance. Again, a return over the last 10 years of just over 20%. A pretty paltry return. But global funds are much more dynamic. They can go anywhere around the world. They can look at these shifts or themes that are developing. And if you look at the top 10 active funds in the global equity universe, you can see returns have been incredibly profitable for investors. So what we're saying here is that don't restrict yourself to an index. Ergo, don't restrict yourself to a passive fund. Another key argument for the pro-passive lobby are their low fees. In other words, they're saying that cheap is good outcome for consumers. Now, frankly, this argument absolutely never ceases to amaze me. Why in every other walk of life would you expect that cheap is value? When we go and buy a car, when we go and buy a house, when we buy clothes, you expect to pay for quality. Surely, if investors can get long-term, sustainable outperformance, in other words, alpha, from investing in active funds, why wouldn't they pay more for that? My personal belief is that this industry is still awash in mediocrity. And if passive funds drive out that mediocrity, I for one would applaud that. That would have to be a good outcome for consumers and investors alike. But if you come back to the UK all companies sector again, 1/3 of all active funds do outperform that benchmark. So if you take time as an investor to do your due diligence, research the right active funds, then a little bit extra you pay will be more than compensated for in long-term returns. But let me finish with one final slide, which I believe is the greatest advocate for active stock-picking investing. If I look at the returns, say, since 1969, for cash, for £1,000 invested, investors would have achieved a return of some £10,000 on the original £1,000. Unfortunately, inflation relative will be now £12,000. So you've actually, by investing in cash, have actually eroded the real value of your money. If you'd invested in the all share, then your £1,000 invested would now be worth over £70,000. Not bad, I admit. In fact, very, very good. But if you pick, say, the Energy Recovery Fund, that £1,000 today would now be worth £390,000. Active investment does work.